on fundamentals of accounting. So we start with a general explanation of what accounting is. Accounting can be defined or explained to be the process of 1. Identifying, 2. Measuring, 3. Communicating economic information in order to permit informed judgments as well as decision making by the users of the information. That is the general definition of accounting. And this is quite a bit heavy for the beginner to understand. But the general thing is that no decision is made in vacuum. And for business organizations or those who may want to make financial decisions, you need accounting information because all decisions are made based on the availability of information. So the purpose of accounting is to identify, measure, and communicate such economic information to those who make decisions. For the financial accounting we are dealing with now, the decision makers normally lie outside of the organization, specifically the public, the private individuals, the employees, the taxpayers, those who want to invest in the company, etc., etc., etc. All these people who are interested in to make sense as to whether to invest in a company or not. Specifically, the main objectives of accounting are as follows. 1, whether the company, people are interested in whether to know whether the company is making profits or losses to enable them to show interest in the company. 2, they want to know the worth, the value of the company or the organization. 3, they want to know the type of transactions the company and whether they are valuable or not. 4, they want to know whether the company has enough cash on hand to carry out its activities. 5, they want to know whether the company is wealthy generally or is poor. 6, they want to know how much the company is owing and to whom. 7, they want to know the type of amount they are owing to the people, whether it is long term, short term, or medium term. Then they want to know whether the company has adequate information at its disposal to be able to operate at all times. You may have heard generally about bookkeeping and accounts, so we need to clarify those things and know the difference. When we say bookkeeping, which is not the same thing as account, the recording, usually in a manual form, of the information concerned with the company, including data that will be supplied. Normally, such information is recorded. So the mere recording of the financial information in the books of the company is known as bookkeeping. So bookkeeping is a process of recording information relating to the accounting activities in the books of the company. Then what is accounting? So that we know the distinction, clear distinction between. Accounting is concerned with the uses to which the accountants put or might make use of what the bookkeeper has recorded in the books of the company. So how the accountant uses the information already recorded by the bookkeeper in the books of known as accounting. So the bookkeeper records, the accountant makes use of the information provided by the bookkeeper. And that is accounting. So if I say they record in the books, what are those books that you record the information in? The first book is the journal, what we call the journal. We'll be looking at the details, the structure, and how these journal entries are prepared. The journal 1, then the ledger 2. Let me repeat, the journal 1, then the ledger 2, then the final accounts. So three principal records or books of entry in the accounting practice. So we'll be taking care of the journal first, then we'll come to the ledger, and we'll prepare the final accounts. But some of the basic principles, the basic principles that govern accounting. The first we start with is accounting equation. What is the accounting equation, or what is an accounting equation? We may explain it that the accounting equation represents the resources the company uses to run the business and where those resources come from. A company does not operate in a vacuum. The company will use resources to earn profit. These resources are typically in the form of human beings, material, and equipment. We don't record these resources in a form of descriptive way. These resources into value, naira and kobo. That is what we record. So for example, if you have a car, you don't write that it's a car. But if you bought a car for 1 million naira, it is this 1 million naira that we will record. Then where do they come from? Where did the car come from? Where did the building come from? How did you acquire the land? All these things describe the sources from where the resources have been acquired to run the business. Most often, you start a business providing resources yourself as the owner of the business. The resources which are provided, those who own the business, is known as the resources the business will, the owner of the business will provide is known as assets. So generally it is expected that the total value of the resources used should equal the value of where they come. So the basic equation is that capital should equal your assets. Capital should equal your assets. And may break this thing down. The capital may be broken down, and the assets may also be broken to show the details of how you acquire the assets and how these assets are used. Some of the assets can last for a long time. We call them fixed assets. Some of the assets can last for a shorter time. We call current assets. Assets can be broken down into fixed assets and current assets. And the capital, if you don't have business, it is just capital belonging to him, but sometimes this capital may not be enough, and he may resort to taking loans from people to help him to add to what he has in other business. All such loans are described as liabilities. So the liabilities are also exported from where resources to business. So we can expand the accounting equation into capital plus liability to equal fixed assets plus current assets. Let me repeat. Capital plus liabilities should equal fixed assets and current assets. This equation will run through all the accounting we shall be doing during this discussion. So no matter how we break it down, it comes back to this basic fundamental accounting equation. It cannot be forgotten. It forms the basis of final accounts. Liabilities equal fixed assets plus current assets. That's what it is generally. There is no accounting information that is provided or recorded without something having taken place. You cannot prepare a record in a vacuum. So before the record is prepared, something must have taken place. And usually, the thing that takes place is the basis for the accounting records prepared. And the thing that takes place or must have taken place is known as a transaction. Transaction. A transaction is an economic activity. And if such a transaction has taken place, it describes an exchange process. That is to say, a transaction cannot take place on the basis of an individual. Transaction involves two people. One giving, taking. Something going, something coming. So it's a two-way activity. It's an economic activity, meaning that it has to have in form of naira and kobo or monetary value. So it's the monetary value we are recording. Let me give you an example. Supposing you bring a car into the business. The car came from the owner of the business. So the owner of the business provides the car and the business accepts the car. So the capital, which is the total value of the car that the person has brought into the business, and then the car becomes an asset for the company to use to run the business. If no transaction has taken place, no accounting record is prepared. And for this transaction to be recorded or recognized for the record to be kept, it has to be. If the owner of the business gives a car to his wife, such a transaction cannot be recorded in the company. And it has to be accompanied by a document showing the value and the nature of the transaction. So it is the document that will form the basis of the accounting record. You buy a car, there should be a receipt. If somebody gives you the car for the business, there should be ownership transfer document that shows that a transaction has taken place. So in all cases, nothing will be accompanied by a document. All transactions that take place without accompanying documents will not be recorded, will not be recognized at all. So it is not official. And before the bookkeeper will record anything, he has to insist on such a document brought into the organization. I wish I had opportunity to ask me questions at it. But if you get this recording at a later date, you may go through it and ask questions as appropriate. Now, I said a transaction would have taken place. A transaction involved two sides. That also forms a basis of what is known as double entry in accounting. Double entry in accounting. That means two sides will be recorded. One going in as follows. If the transaction involves real assets, that is to say, assets are involved in the transaction. All assets that come into the organization to increase what is already there, we do what is known as debit entry. If it will reduce the assets, we do what is known as credit entry. On the liability side, all liabilities all transactions that will increase liability and capital will make credit entry. And all transactions that will result in decreases or reduction in liabilities and capital will make debit entry. Debit entry. So we have debits and credits. And let me go over again. If you want to make a debit entry, one, you make a debit entry to increase assets. That is to say, any transaction that will tend to increase the assets will be debited. Any transaction that will tend to reduce liabilities and capital will make debit entries. So debit entries will be made where increases in assets are required or reduction in liabilities and capital are required. Then we make credit entries where reductions in assets, increases in liabilities and capital are required. Now, a huge problem that is actually is to know what are those assets, what the transactions will be so many and involve so many that your problem of knowing what particular item, whether this particular item involved in the transaction is an asset or this particular asset, this particular thing affected by the transaction is liability. That is going to be so getting familiar with the various transactions that take place so that you will be able to know which one is liability and which one is. Let me start an example. The owner of the business start the business with 10,000 or let me say 1 million naira. If you start a business with 1 million naira cash, this means the capital will be increased because the account that represents the owner's interest in the business is capital. The capital will increase, the assets will increase. So since capital will increase, we are going to credit it. And since the assets will also increase because the asset is the vehicle, the car. Since the asset will also increase, going to debit. So one credit entry, the other one debit entry. Increases in capital credit entry, increases in cash credit entry. So one debit, one credit entry. Now, if the owner of the business uses some of this money to buy some goods from a supplier, he buys some goods. Let us assume that he buys, shall we say, he buys furniture from a supplier. Again, furniture, that is the table and the chairs you use in the office, they are assets. So since they belong to the company, that will also increase. It will be debited. Now, cash is an asset. If you use cash to buy, the cash has reused to the extent of the amount that will be used to buy the tables and the chairs. So cash will reduce, and therefore we shall credit cash and the furniture you have bought. Sometimes transactions will involve two debit entries or two credit entries. These are the details we will take up at a much later date. Now, I'm assuming that since there is no feedback on this, I'm assuming that you have the opportunity to ask questions later. So let me read out a short assignment to bring this thing home, what the discussion we have had so far. Now, let's assume somebody starts business on a particular date. And the person who started the business is Mr. Philip. What you are going to do for me is to record for me whether the particular transaction will be a debit entry or a credit entry, or both of them. The business started on July 1st. Then Mr. Philip started a business with 150,000 naira cash in the bank. 150,000 naira cash in the bank. So this type of transaction for July 1, which I'm going to do for you. July 1, Mr. Philip started the business with 150,000 naira cash. That means Mr. Philip's account, which, as if you remember, I told you it should be capital account, since the owner of the business. Mr. Philip's capital account will be credited with 150,000 naira, and the bank account, since the money has been sent to the bank account will be debited with 150,000 naira. Then two sides of the transaction would have been recorded. So I've given you the first one. Now, try one at the following. On July 2, office furniture to the amount of 12,000 naira was bought and a check was issued. A check was issued to buy 12,000 naira on July. Then July 3, office equipment was bought on credit. Office equipment was bought on credit from Mr. Theophilus by the company, and the amount involved is 4,000 naira. 14,000 naira office equipment was bought on credit from Mr. Theophilus. On July 5, on July 5, the company bought. On July 5, the company bought a lorry, a van, again on credit from X company to the tune of 600,000 naira. The company bought a van from X company to the tune of 600,000 naira. Then on July 8, the company sold some office furniture which they found not to be suitable. The company sold this furniture
Hello.
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 The company Polari. The company sold office furniture which they found not suitable to Mr. D, and the amount involved is 15,000 naira. 15,000 naira. Then on July 15, the company paid the amount going to Mr. Theophilus, which was incurred on July 3rd. Remember I said July 3rd, company bought office equipment already. This was paid for on July 15. Then July 23rd, the company received the amount it sold to Mr. X. This furniture is sold to Mr. X on credit. The company received the amount. Then July 31, the company bought more office equipment and issued check. Amount involved is 65,000 naira. The company bought office equipment and paid 65,000 naira for it. You try your hand at this and you let me know the result of your effort the next time we meet. Am I okay?
You are now unmuted.
So hopefully next time the attendance will not be disrupted so that we'll have a more useful discussion. All right, good night.